generally higher interest rates. So this was essentially, I would say, how the year 2024 went and how it impacted the market.
Okay, so I'm still on you now. Now, how do you see the interplay? Essentially, what's the outlook for monetary policy and economic growth in 2025?
Okay, so in 2025, so if I start how I started the initial question, looking at the US, I know that now that we have a new administration in the US with Trump coming in, there's a lot of question. And what I think is important for economists, investors, institutions to realize is that there's a lot of uncertainty, right? So one major issue is regarding tariffs, right? If we see tariffs come into play to the level that has been promised by the current US President Trump, we will see that import duties are going to increase, right? Now, it's not a question of how much are these companies going to pass on these costs to the consumers, and I think that that's going to happen. Now, that could lead to inflation, and it could lead to the Fed in the US deciding to hold back on their mini streak of easing monetary policy. So we might not see interest rates come down to the level that we might have expected, sometime towards the end of last year. And what are the implications for the markets if that happens? We'll see that there will be a lot of uncertainty, there will be a lot of volatility. We might see that the equities market might not be as attractive as initially expected. We might start to see that the high valuations of the large cap stocks in the US might start to reach the point of being disillusioned. Reality starts to dawn on them. So expectation for monetary policy in the US, I expect that should, will be heavily data driven, just like how they've started. So we'll just wait to see how much Trump is going to enact a lot of things that he promised. I'm tilting more towards the equities markets continuing its positive streak. I think that the Fed is still going to ease monetary policy. And looking at the other markets, I'm not as excited with the European markets. I think the Eurozone has quite a few issues. Yes, we saw some easing from a monetary policy standpoint with the Eurozone, but there are some political issues there. So France's June snap election, for example, that's going to have its negative impact, right, on fiscal spending. Also in Germany, they're going to have an election, a federal election, and in anticipation for that, that's also going to have, negative impacts from a fiscal expansionary standpoint. So, with these in mind, I'm not as excited for the European region as I am for the US. However, I still think that they would maintain their growth. Like in the US, I didn't mention, in the US I expect to maintain their growth. I expect to see about a 2.1%, so not as strong as the 2.4 we saw in 2024, but still a growth. In emerging markets, I expect to see positivity. I expect to see a lot of investors want to take advantage of the carry trade opportunities because, like I said, I expect that easing to continue in advanced economies. So I think 2025 is still looking positive. I think that China might still be reeling from a lot of the woes they've been suffering from since they had the real estate assets bubble burst in 2022. I think that they're still having to deal with that, so we might still see growth still subdued, and that would have its own negative impacts on the global supply chain, on the global markets, right? So I think it's mixed, but on the net, I think it's tilted towards the positive for 2025.
Okay, thank you very much, Mustafa. That was quite enlightening. Augustine, I'll move over to you now. Now, as you know, the President of the United States of America, Donald Trump, has vowed to increase oil exploration. Now, in the light of that, how might global energy market respond to non-OPEC supply expansions with the United States potentially increasing oil production in 2025?
Okay, thanks, Oluchi. So let me just explain how oil prices work. Like most commodities, it's affected by demand and supply. Presently, over the past few years, The world's average daily supply has just been slightly over 100 million barrels per day. And where supply exceeds demand, then you will have prices drop, and the reverse is the case as well. So right now, US is already producing over 13 million barrels per day, which is higher than any country has ever produced. And if Mr. Trump says he's going to increase that, then that could mean there will be higher supply. But at the same time, there are other factors that will affect supply as well. So you have Nigeria, for example, ramping up supply. You have some of the OPEC plus countries, such as the UAE, trying to exceed its own quota. So that means that supply could be higher than what we've been seeing. Especially if prices rise, then there's incentive for non-conventional crude to come up on stream, such as the US shale, the Canadian heavy oils. But the funny thing about rising supply is that once the prices start depressing, then some of these conventional oils will start to come upstream because it's no longer be profitable for them to produce. And so that's why you have been having this equilibrium around between 65 and 80 in recent years. So that's the thing. It's a fine line. But OPEC Plus has already said that they will extend the production cuts. Saudi Arabia, of course, has been championing that because they have the capacity to do more than they're doing presently. So basically, what do we expect? We expect that Mr. Trump will realize that pumping too much oil too soon could actually destabilize the financial markets across the world, not just financial markets, not the whole market. So I think a lot of what he's saying will be more rhetoric than really what they'll come out to do. So I don't expect U.S. oil production to exceed 14 million barrels, which is just maybe a few 100,000 barrels upwards from where they are presently. So our own view is that we'll see oil prices around between 72 and 77 for this year 2025.
Okay, thank you, Augustine. I'll move over to the next question.
Okay.
Now, inflation in the US and EU gradually declined throughout 2024 from their peak in 2023. Now, do you think that inflation may progress towards or sustainably fall below the 2% target in 2025?
Okay, just like Mustafa had said, inflation had been quite high in recent years. Of course, we had the post-COVID stimulus package. The US spent upward of $2.3 trillion trying to revive the economy. And you could say that they had a soft landing. They were able to bring inflation down without going into a recession. A lot of analysts had thought that the US had to slip into recession to bring those inflation rates down. They were able to do that without going into recession. However, we've seen inflation remain stubborn in the US and also in other developed markets. So he has said that pumping oil will allow prices to come down more, which is true. We could get closer to the 2%, may not be hit that 2% as expected because some of those inflationary factors are still there. So, for example, some of the subsidy and spending is still, still acting. The U.S. spending on infrastructure is something that they're still pumping money into the economy because of that. So those are inflationary factors. Then also other European countries, even China will still try to activate their stimulus, which they have. So it means that there are some factors that will ensure that inflation will probably remain above 2%.
Okay, thank you so much, Augustine. Ayomiko, I'll move next to you. Now, can you help review key events in the domestic economy and how it shapes the Nigerian markets in 2024?
Okay, thank you very much, Oluchi. Talking about the Nigerian economy, the trajectory has been quite interesting in the past 12 to 24 months. But then I would like to paint a picture just for us to have a clearer understanding on how the economy has shaped, in the last 12 months, right? So if you look at where we are coming from, we had a change in government in 2023, and from that change, what you mostly noticed from the previous government was that their behavior was really characterized by fiscal recklessness. And what do I mean by this? We saw a lot of liquidity injection into the system. We saw that deficit financing was the order of the day, and even in terms of this deficit financing, most of it was done by it was done through the ways and means advances from the central bank, right? So what this essentially means is that we saw the CBN app give a lot of funding to the federal government, right? And from the statutory limit that we have, from the CBN Act, ways and means advances for a year is not supposed to exceed 5% of the actual revenue from the previous year. But we saw that was flaunted several times, right? And that's one of the reasons why we are where we are today. So what that did was that we saw, like I said before, a lot of significant liquidity injection that was not backed by productivity, neither were they backed by a commensurate increase in the gross external reserve, right? And that's why we had a lot of issues with our exchange rate. We also, we have also seen how significantly inflation have jumped from where they were previously, right? So apart from that, we have also seen that this current government have implemented a lot of reforms in terms of the removal of the PMS subsidy, which is something that a lot of multilateral organizations like the World Bank and the IMF have called for in the past. It was eventually implemented, and what that did was that PMS prices jumped significantly from where they were previously, around 170 to 200 naira per liter, depending on the location you were buying from, then to where we are currently, almost at some point exceeded 1,000 naira levels, right? So all of these reforms, including the FX liberalization that was enacted by the Tinubu government immediately it came into office, all of these factors significantly shaped the events that we saw in the Nigerian economy last year. So what we saw was that inflation jumped significantly, right, reaching 34.8%, in the month of December. We've also seen that food inflation has also been a major concern. At some point, it reached 40%, retraced, and now it's also going back, again. So all of these, were the major events that we saw in the market in 2024. So apart from inflation, right, in response to this inflation, try to fight inflationary pressure, we also saw, like Oluchi alluded to earlier, that the CBN raised rates significantly by about 875 basis points in the year 2024. And apart from raising that interest rate, another interesting point that I would like to mention is that what we used to see previously, right, was that even when the MPR used to be hiked, we didn't see the corresponding increase, in market interest rate. So you would typically see that meetings will hold, the CBN will hike rates, and subsequent treasury bill auction, for example, you will see rates drop. So it was as though the NPR was just a symbol. It wasn't effective. So what this central bank, under the leadership of Governor Yemi Cardozo, have tried to do is to ensure that that mechanism is now in place, right? So that when we see the benchmark interest rate go up, you would typically see a corresponding increase, although there's still that negative real return, right, in that inflation is still way ahead of interest rates, but we have seen notable improvement from where we're coming. So last year, for example, we saw the stop rate on the one-year treasury bill peak at 23.5% in November. That was very, very high, and for most part of the year, it hovered around the 21-22% levels, and like I said, peaking at 23.5, right? And what that led to was that we saw significant interest from foreign portfolio investors into the Nigerian economy, and that helped in shaping the dynamics of the foreign exchange market, right? So we now saw substantial level of liquidity from the foreign investors, and also worthy of note, right, is that some of the reforms that were embarked upon by the Central Bank of Nigeria in a bid to make the economy attractive enough for foreign investors, yielded positive impact, right? For example, we saw that diaspora remittances increased by about 61% last year, year on year, and it got to, I think, around 4.22 billion, as of the first 9 months of 2024. So, I mean, all of these were the major events that we saw in the Nigerian economy, which was mainly characterized by high interest rate, high inflation, volatility in the FX market, which at this point has now, subsided a bit. The CBN also introduced a lot of reforms in the FX market. At the tail end of the year, we saw the introduction of the electronic foreign exchange matching system, that's the EFEMS system, which allows investors to see real-time data in terms of offer and bid prices like you typically see in the equities market, which is aimed at promoting transparency, eliminating artificial and non-existing demand, just to create fear and then distort the market. So I mean, these are the major events that are shaping the market in 2024.
Thank you so much. That was quite enlightening. Hannah, recall that when I made the introduction, I said inflation, we saw inflation as of December last year getting to as high as 38.40%. Now, with inflation reaching that high last year, do you think the CBN would remain aggressive with its monetary policy tightening in this new year?
Okay, thank you, Oluchi, for that question. So for 2024, when we look at what the MPC did in terms of monetary policy, we saw them, they were really committed to their price mandates, price stability mandates. And then we saw them raise rates as high as 875 basis points to 27.50%. And in addition to that, they also raised CRR for both commercial banks and the merchant banks to 50% and 16% respectively. And they also changed their symmetric corridor to plus 500 and minus 500 pips. All of this in an effort to tame inflation, reduce the negative real rate of return, and also stabilize the naira and also manage inflation expectations. So going into 2025, in terms of inflation, first we'll talk about the CBN rebasing. So the CPI rebasing, if we're looking at that, that should actually, kind of tame inflation. By the time the rebasing is done, moving some significant portion from food to other weights, to other sub-indices, that should actually, minimize in terms of, we'll see inflation coming down lower. And then when we look at it last year, high base effects should also affect inflationary pressures positively this year. So when you're looking at that, and then for this year, we don't see them going as high as they did in 2024, sorry. So for this year, we think that the MPC will actually hold rates. So what are my reasons? If we look at it, when we're looking at GDP is around 3.4. GDP is still very resilient. And then when we look at, inflation might actually be tamed this year. This deflationary process might actually start occurring later this year or at the beginning of this year. So if we're looking at that, you don't think that they would want to, further increase rates. So for this year, we're looking at them for this January meeting, 25 bips and a hold for the rest of the year. Maybe towards the end of the year, till end of 2025, we might see a cut. But for now, data supports like a hold till for 2025. And then if we're looking at what are the other global, CBN monetary policies, what are they doing? Look at ECB cutting rates. If we look at BOE also cutting rates, then if we look at the Fed, because of the inflation risk stemming from tariffs and the rest, they are probably going to be on hold for most part of this year. So there's no significant pressure on the CBN itself to also increase rates. So if we're looking at it, global monetary policy easing, we think that for the rest of the year, just for January, maybe 25 bips, and for the rest of the year, a hold till 2026. Thank you.
Thank you so much, Hannah. I believe that this session has been enlightening so far. We'll go on a short break right now. I implore that you do not go anywhere. Thank you.
A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. For further inquiries, visit www.investment-one.com to get started. Welcome to The One. One place of possibilities. A niche for financial success. The one place where your dream is the priority. From wealth management and financial advisory to retirement planning, a place with a dedicated team with various expertise guiding you to financial freedom. One door always opened for end-to-end business solutions. One place to help you exceed expectations. Welcome to The One. Welcome to The One. One place of possibilities. A niche for financial success. The one place.
My name is Tomiwa Opini, the head of corporate communications and social product at Investment One. Investment One is an asset management firm that's our mission is to help our clients achieve their investment goal. We decided to come up with this novella called The Money Wheel to actually drive down the explanation of investments and the need for people to invest in different financial instruments. So we wrote this book to explain a lot about investments, and we hope you guys find it very interesting.
Thank you for joining us. We're still discussing investment trends for 2025. So please, if you've got any questions, you can send them to the chat box and then we'll discuss them at the end of the session. Now, Mustafa, I'll come back to you. So recall that last year we really saw a lot of interventions by the CBN. They tried so hard to, curb inflation, bring down inflation. Now, for this new year, do you think, what specific measures do you think the Central Bank of Nigeria should prioritize to bring the inflation to sustainable levels?
Okay, thank you for that question. So, number one question back, what are sustainable levels? Okay, and the second thing we ask is, what are the drivers of inflation? Theoretically, inflation typically is driven by a few factors. This could be demand, right? So when you have aggregate demand, rise, so that could cause inflation in prices of goods and services. It could be from a supply standpoint, right? So typically, when you have restricted supply, then that's impacts inflation. It could also be from a money supply standpoint. So typically, when you have a situation whereby there's probably quantitative easing, ways and means that we had in Nigeria, and there's excess money supply into the economy, then that could lead to inflation. Now, what is causing inflation? Because if we answer this question correctly, then we'll be able to answer the question on what the CBN should prioritize in tackling, right? What essentially they should put their targets on. Our inflation is really driven by cost push factors, right? Yes, a very key element that we cannot discount, we cannot ignore is the money supply, right? So if we look at money supply, if we look at M3, the aggregates significantly increased. And one major factor of that was the about 37 trillion naira which was put into the economy, right, by the previous administration, whereby they were going beyond the 5% of the previous year's revenue in terms of overdrafts from the CBN. So about 37 trillion naira, which has now been securitized, was pumped into the economy, significantly increasing the money supply. Okay, yes, that may have contributed, or that did contribute to the level of inflation. But when you look at our situation, you look at the curbing mechanisms that the CBN has adopted in order to reduce money supply, and then the transitive effect, it has been muted. So it really is the cost push factors. It's the cost push factors. Now, let's look at what the CBN has done so far. The CBN has done a lot of things within their purview in order to be able to manage this. Raising inflation rates, right? Interest rates rather, not inflation rates. Raising interest rates. We saw in last year, 2024, 875 basis points increase. That's almost a 900 basis points increase in interest rates in order to restrict money going into the real economy. Now, while they have put out open market operations instruments, the OMO instruments, in order to mop up liquidity from the system, put out attractive instruments generally to mop up liquidity. So I would say that from the monetary policy perspective, which is what is within the purview of the CBN, they have taken those steps which are data-driven, right? You would expect that there will be a higher level of interest rate hikes in Nigeria than you will find in other climes due to the level of inflation and the level of money supply that we had in the economy. However, one thing that is important for us to mention is if we're going to battle inflation, like I said, we need to analyze what is causing our inflation. And like I said, it's the cost push factors, right? We have significant reduction in terms of food supply because farmers are not going to the farm. Why are they not going to the farm? Because they are scared for their lives, right? So there are security issues which need to be tackled. Now that's outside of the purview of the CBN, right? Aside from security issues, essentially, arming them with the infrastructure, with the technology, with the farming instruments that are needed, like tractors, and machinery, in order to be able to boost food production. So these are things that are outside of the purview of the CBN. In addition to that, one thing that we can also do in order to, curb the level of inflation that's coming from cost push factors are to improve on the infrastructure. When we have logistics improve, this will also help with inflation. So what I'm, essentially saying is that in terms of priority, I think that the CBN should just focus on their core mandates. And I think that the unorthodox policies which we've been seeing from the CBN over the years have taken a U-turn, especially in the last year, when we saw more orthodox approach to tackling inflation, right? So, initially with the new CBN governor coming in, we saw, some U-turns in terms of, CRR levels, with the banks. And returning to that orthodox monetary policy allows for us to have proper forward guidance. It allows for us to be able to see where we really need to focus on and be able to tackle inflation. So, from the CBN standpoint, focus, their priority should be to focus on their core mandates, and their core mandates are price stability, maximum employment, price stability with, one, trying to mop up liquidity from the system because of the heightened money supply. And secondly, price stability with the FX, right, with the Naira rates. Now, the CBN, I think that initially, yes, they were trying to tackle inflation, or they are trying to tackle inflation. However, not in a quintessential manner that one might think. It's from the FX standpoint, because FX constitutes a major part of our, of our inflation, of what causes our inflation. So imagine, just like we did see in Nigeria, Naira, depreciates by 50% or by 100%. That's going to have significant impacts on commodity prices, on a lot of things, well, because the FX is very important to to maintaining our inflation. So, and I think the CBN has taken steps in that direction with bringing FPIs back in the country, right? And now what we've seen in FX markets is relative stability. So the level of volatility we saw last year is not present anymore, and that is improving confidence. It's also raising our FX reserves. So I think these are the priorities that the CBN should focus on. What they've been doing is just for them to do it more efficiently, bring in better systems, just like the FNs, which I mentioned earlier, in order to manage all these markets, the FX markets, to manage money supply. I think those are the priorities for the CBN.
Thank you. So I think it's safe to say that the market will find a steadier reading this year. Hannah, how effective has the government's foreign exchange stabilization policies been, and what additional interventions could strengthen the Naira in this new year?
Okay, so thank you for that question. So at the beginning of last year, we saw that the Naira faced significant pressure. Naira was as high as, depreciated to as high as, 1/8 in the parallel market. But during half year, or Q1 and beginning of Q2, end of Q1 and beginning of Q2, we will start seeing some significant reforms like unification of the exchange rate. The CBN tried. We saw the unification of exchange rates. We saw the removal of limits on international money transfer organizations. We also saw orthodox monetary policy in the sense that OMO rates increased to reflect, yields increased to reflect what is happening with the MPR. And apart from that, we also saw introduction of more transparent communication systems such as the eFirms, so that people can see what is happening with the exchange rate. We also saw they also came up with retail Dutch auction, and then at the international markets, they also went to Eurobond, 2.2 billion naira. We also saw domestic dollar bond issuances. So all of this, was effective, bringing down the Naira from as high as 1.7 towards, 1.5 towards the end of last year. So that was significant. We can see that, yes, these stabilization processes have been working. CBN has tried, and we can see that effect. So what other intervention can they do in 2025? I think for me, they've actually done a lot. They just need all of this to be consolidated in 2025. And just like Mustafa said, what are the fiscal doing? We look at the fiscal side in terms of tax reforms, in terms of, oil production, oil receipts. Are they doing well? How are they going to increase oil production? Fine, we know that this year we don't really project significant, increase in oil prices, due to Donald Trump and his whole, drilling. So when we look at it, and then demand, oversupply in the oil market, so we don't really expect so much when it comes to oil prices this year. But in terms of our own oil production, how can we increase our own oil production in terms of tax reform? So we just need the fiscal end to support what the CBN has done last year, because CBN has actually done a lot, and it also reflected in terms of our reserves growing as high as 40 billion last year. So this is actually a lot. So for me, I would think that it's just time for the fiscal side to also lend a hand, and in that way, we could see, Naira further appreciate, at least in 2025. Thank you.
Thank you, Hannah. Augustine, I'll move back to you. Now, you are a risk professional with decades of experience, and you've witnessed the Nigerian economy go through cycles of boom and downturn. Now, with the present period of volatility in Nigeria's financial markets, what risk management strategies should investors adopt to protect their portfolios in 2025?
Okay, that's a very good question. So usually, the first thing is you need to be informed. And basically, you need to consume information. Investment One research turns out tons of data information on a regular basis. So you need to know what's happening in the market. You need to understand the jargons. So that's the first one. Keep yourself informed. Secondly, like Warren Buffett says, don't lose money. Okay? So before you start to build your wealth, you need to stop leakages. So first, you need to budget, and then you need to cut expenses. So that's very, very important. Then I always preach diversification because research has shown that, and this is well understood and agreed upon, that diversification and asset allocation are the single most important factors toward growth of investment. Okay, so what do I mean by asset allocation? It means that you need to have a scientific way of allocating your capital. Okay, so for example, if you're going to put money in fixed income, put money in equities, put money in other asset classes, even if you're doing properties or other things, asset allocation is key. And then you look at what the higher earning, higher interest earning investment opportunities or asset classes are right now. So for example, the guys just talked about treasury bills at rates of over 22%. So I would expect that is risk-free. Basically, risk-free money right now in Nigeria is 22%. So my own asset allocation right now, I'm leaning heavily toward treasury bills. So that's good. And what we are seeing is that because it is the possibility of interest rates dropping during the year 2025 is there, so we're having investors lock in monies at 1 year, maybe 1 year treasury bill and above as well. So that's why you're seeing those high rates. But they will start trending downwards as we go along the year. So I advise that you put some money in asset classes like that. Then also, it's good to have exposure to US dollars because basically, because of depreciation, what we've seen over the past few years, no matter how high your return on investment in Naira is, when you convert it to dollars, you're actually losing money. I think year on year, between 2024 and 2025, the Naira depreciated by over 70% or so. So, I mean, if you are investing in this, the Nigerian stock market returned, the SI returned about 37% or so last year. So, I mean, the Naira fell by twice that. So, no matter how well you do in the stock market, if you are holding money only in Naira, and especially if you have, you have exposure to foreign currency. So, for example, if you are planning on doing investments abroad, or you are planning on traveling, or you are planning on you're paying school fees abroad, then it's good for you to have exposure to foreign currencies and then foreign currency assets. I mean, the US stock market did very well last year, for example. So if you feel that you have the appetite for equities, you could consider something like that, or do mutual funds. So those are some of the strategies that I personally will advise.
I mean, you've hit the nail on the head. You preaching diversification, being able to protect your assets, it's really touched on. So I'll come over to Mustafa now. Now, how does Nigeria's successful return to the Eurobond market impact investors' confidence, and what are the implications for further external borrowings in 2025?
Okay, so Nigeria being able to return to the Eurobond market is indicative in of itself. It's indicative of increased confidence that has been built by a few factors, like a return to orthodox monetary policy, that we've seen from the central bank over the last year. Also, general improvements in macros, like expectation for inflation to abate this year. also improvements in key indicators like our crude oil production, foreign external reserves, that's also rising, FPI inflows rising. So I think Nigeria's return to the Eurobond market is indicative of that, right? And obviously, we had our Minister of, Coordinating Minister of the Economy in Davos recently, and the general feeling is that this is not going to be the last, visit to the Eurobond market. With there being, improved confidence now, I think that investors will be looking to key into the Nigerian market for a few factors. The attractive rates. I think the rates are, quite attractive, especially when you consider the carry trade factor with advanced economies being expected to further cut rates, right? So it does really make a lot of sense to consider emerging economies, frontier economies, Nigeria one of which is. So yes, I think that this is one of the few that we're going to one of the few visits into the international debt market that Nigeria is making, and with these indicators improving, I could expect crude oil production, crude oil price. We expect it to come in at about $72 per barrel, between $72 per barrel and at best $77 per barrel. That range is still within the Nigerian budgets of $75 per barrel. So if we are able to improve our production to good levels, Welligent, for example, they do expect that Nigeria's crude oil production will be about 1.8 million barrels per day. So there is some optimism in regards to that. I think that if you look at our Trans-Forcados pipeline, for example, there are about 150 outlets which crude oil theft was going on, through which crude oil theft was happening. So that is significantly reducing. So just the general improvements in our oil sector, improvements with inflation, positive GDP growth. I think that this will continue to improve investors' confidence. And lastly, one key thing which we are really looking forward to is the next communique, next report released by the to further equip us with the ability to go into the international debt market. So I think that Nigerian Eurobonds is indicative of these progresses that we've made. Still quite a bit to do, right? We're just in the course correcting phase. I would put it as that. Our reports outlook, which should be out very soon, is titled transitive recalibration. So that's essentially speaking to the phase that Nigeria is in. We're recalibrating. So it's after recalibrating that's how to advance. So but yeah, that's my views on
Thank you. That was spot on. Ayomiko, beg your pardon. Now, as we witnessed in 2024, we saw variables such as inflation, interest rates, and other statistics have a major impact on the day-to-day lives of Nigerians, and more people are beginning to get interested in these statistics. Now, what is the outlook for key macro variables like inflation, economic growth, and monetary policy?
Okay, thank you very much, Oluchi. So looking at some of these key variables in the Nigerian economy, I would like to start with inflation, right? We've spoken largely about inflation in this session, and the general outlook is that we should still see that inflation at some point will start to retrace downward, and we expect that this will likely start from January. Maybe if not January guarantee, right, we should start seeing decline from the month of February, right? So it's now a question of how fast, how quickly will inflation decline, to the levels that we desire. So, for example, in the 2025 budget estimate, the expectation for inflation that the federal government has is 15%, right? We believe that might be a bit too optimistic, although we largely align with the expectation that inflation should decline, but we don't expect that we might go that far to 15%, right? So in terms of likely factors that might drive inflation, one, we expect that the base effect should be a major factor. The base effect is quite favorable, right? We've seen inflation jump significantly in the past few months. So from now, we should start to see respite based on that. Apart from that, we also expect that our expectation for stable foreign exchange rate should also be supportive of further decline, or for us to start seeing decline in inflation numbers across board, right? So what we're expecting is that for FX, due to some of the reforms that were highlighted earlier, and the fact that we are beginning to see higher receipts from foreign investors, right? Although you classify that as hot money, which is the kind of money or investment that is very, very short term in nature. It doesn't last for so long, unlike FDIs. But then we still believe that it's a positive for the foreign exchange. So on that basis, of seeing stable FX rates, we expect that should be a positive factor for inflation, because of the significant impact of the foreign, the imported food index stability in PMS prices, right? So if you recall, in July and August 2024, we started to see inflation drop, right? But that decline was short-lived. Why? Because it was at that point that the full implementation of the removal of subsidy was effected, right? So we saw that affected the trajectory of inflation, and from the decline we saw in those 2 months, we started to see PMS prices should be supportive of lower inflation for 2025, right? So our base case expectation is that we should see inflation coming at around 23 to 26%, right? There's also the rebasing leg that Anna has alluded to earlier. We expect that with the rebasing of the CPI, which mainly has to do with the adjustment of the weightings, across the various indices, we expect that this might, to some extent, hasten the downward path, of inflation that we're expecting. So with that, we should possibly see inflation touch, 23%, right? So our base case expectation is between 23 to 26%, right? So for economic growth, like we've seen since the pandemic-induced recession that we saw in 2020, we've seen that the economy has remained largely positive. Growth has been maybe not up to historical average, where previously we used to see the economy grow by 5, 6, 7% thereabout, right? We've been seeing growth rate over around 2, and now they've improved to the 3% levels, right? So the expectation is that this growth rate should still persist. We expect that sub-sectors like the financial services and financial services as a whole should be positive for the GDP numbers. We also expect that the ICT sub-sector, which has been a major driver of growth, should still continue to drive growth in 2025. We've seen that there will be likely increase in tariffs, which means that the players in the telco sectors now have more to play with, and we've also seen that sector has been quite innovative, with a lot of innovations coming in from them trying to utilize, serve Nigerians through payments and other services like you have the likes of Momo payment and all of those innovations. So that has also been a driver of growth in the Nigerian economy. So we expect that all of these factors, right, should still keep the GDP numbers positive, although in terms of constraint or downside risk, right, you have still tight financial conditions. That is something that might likely affect the non-oil sector, right? But we expect that overall, with this point that I've highlighted, that the economy should continue to grow. And from the perception of the rebasing, right? So if you recall, when the last rebasing was done in 2014, the economy expanded in dollar terms from about 270 billion to about 510 billion, right? So we expect that we should still see that in 2025 by the time the rebasing is eventually implemented. We expect that from what was mentioned from the discussion about the rebasing, we saw that they are going to introduce a number of activities like the NHIS, that's the National Health Insurance Scheme, and also the activities of the pension fund administrators will now be captured in the GDP, right? And another interesting point is that according to them, illegal activities will also be captured, which is something that we are looking forward to, and it will be interesting to see how that will be done. So if all of these are eventually implemented, we expect that there will be more activities to be captured in the Nigerian economy, and that would spur growth far more than what we're initially expecting, around 3.7 to 3.8%, right? So if we eventually see some of these addition because of the rebasing, we should see that growth rate should possibly be as high as 5 to 6%, right? So, and that's about inflation and then GDP. And for interest rate, like it was also mentioned earlier, right? Nigerian economy, as we speak, allows for high interest rates, right? It's one of the price that we have to pay, for where we are currently. So we expect that interest rate will still remain elevated. It's likely that in the first meeting of the year, which is scheduled to hold on the 17th and 18th of February, we expect that the MPC should keep rate elevated and likely raise rates further by 25%. One thing that we have seen from this CBN, the current CBN, is that they appear to be adamant on their price stability mandates, right? So on the back of that, we expect that they should still raise rates slightly by 25 basis points. But from that point, right, we see leg room for a hold stance. We expect that they will hold rates constant, all through the year, and we foresee a likelihood of, say a 25 basis points decline or a cut, towards the end of the year, probably in the November meeting. But largely, we expect that, because of the current inflation rate, although we expect that to decline, like I mentioned, and particularly because of the dynamics of the foreign exchange market, knowing that, one of the reasons why we've seen stability in that space is because of the attractive carry trade, right, that we are currently seeing due to the, high yield environment. So we expect that, interest rates should still remain largely elevated for most part of 2025. And finally, for foreign exchange, like I alluded to earlier, we see scope for stability in 2025, unlike what we have seen in the past, where it was highly, a case of volatility, right? We've seen substantial devaluation in the currency. We think that this is the time for us to see some sort of stability in the market, and then this, of course, we expect that it will be driven by the increased FPI inflows that we have seen in the Nigerian economy. We've seen that the CBN has also been consistent with their issuance of open market operation instrument, that's OMO bills, and then that is targeted at a dual purpose of keeping financial conditions tight, that's mopping up liquidity in the system and also attracting FPI's inflows into the Nigerian economy. So with this factor and also the fact that we've been seeing consistent increase in diaspora remittances, right? Like I mentioned earlier, the CBN they've been resolute on trying to ensure that remittances coming through official sources, right? So this has also been a major factor in the FX space. And finally, the fact that we've seen that the reserves has grown, although recently we've seen some pullbacks, majorly due to the funding of some external debt obligation, particularly to the World Bank, right? But the expectation largely is still that we should continue to see accretion, in the external reserve. So all of these paint, a positive picture, for the foreign exchange market. And as I conclude, we do not rule participants in the market need to fund, their foreign obligations. Some people might need to travel, pay school fees, and all of that. But we expect that the implementation or the continued implementation of the eFirms, platform should provide respite for the Naira in periods where we see heightened demand, such that the impact of speculation will now be reduced because of the implementation of this platform. So I think all of these basically are our outlook for various macroeconomic variables in 2025.
Thank you so much, Ayomiku. Now, my last question will be directed towards Mustafa and Augustine. Now, what opportunities and investment options should clients explore during the year?
Okay, fixed income remains good. You talked about the fact that we expect interest rates to remain elevated, so fixed income definitely. Traditionally, Q1 is very good for equities, particularly now that the banks have recapitalized. People expect that the kind of dividend payout will be quite good, so we expect the investors to line up to enjoy some of those. So those appear good as well. So for me, those are my top two. Maybe Mustafa has some others you'd like to add to that.
Yes, just in addition to what Augustine has said, I think, in approaching the markets for opportunity this year, one needs to be, number one, cautious, because I think that there's still a good level of uncertainty, and this is stemming from the potential consequences, if you will, of a Trump presidency. So could we see tariffs, for example, and to what extent? Could it be as promised? How is this going to impact the global crude oil markets, right? How is this going to have an impact on inflation? And what's going to be the corresponding response from the monetary policy authorities in these different regions, right? So when you take all these into consideration, it will really guide how you should approach the markets. Now, all things considered, we think that generally there will be interest rates easing, right, across the advanced economies. And what this in turn should do is help to boost or help to continue the positive run that we've seen in the equities markets. If you look at the MSCI World Index, which is like an equity market index, it's like 70% constituted with US equities, US stocks. It did perform quite well. Global indexes did 20% plus last year. So we expect that will continue in 2025 due to the continued reduction in interest rates, as I mentioned. In terms of sectors to look at, I think this will be even more important than trying to focus on indexes. So sector-wise, I think looking at the financial services space, due to an expectation for reduced regulation, reduced level of bureaucracy for the players in the financial sector, especially the regional banks and those ones in the Russell Index in the US. So I think that there's opportunity, in those spaces. Also, sector-wise, if we look at the tech sector as well, this is hyped really. So it's almost like a make or mar year.
Yeah.
If it's a make year for it, then I think there's significant returns to be made in the AI space. Also, looking at energy stocks, they could benefit from seeing a less than expected, you know, sanctions imposed by Trump, because we generally expect that crude oil prices will remain suppressed this year due to potential sanctions on Iranian vessels on the sea. Also, the expectation of lower demand from places like China, who are the world's largest consumers of crude oil. If we see that the actions that are being taken by the PBOC, that is the People's Bank of China, come into effect and have significant positive impact on the Chinese economy, we could see that the demand could go up, right? The demand could come out better than initially expected, and that would be good for crude oil prices and in turn energy stocks. Although I would say that there are some risks, there are still risks there. It could go the other way, just like we did see in the first Trump administration with regard to tariffs specifically, for example. Those tariffs that Trump promised in his first administration, right? It didn't really, go through with it as he touted. So, we need to be cautiously optimistic with regards to the foreign equities space. I think for now, we should, maybe not Japanese equity space, right? So the global equity space, maybe bar Japan. The Nigerian equity space coming home, I think there's still, a lot of bargain hunting activities. I think the PE ratios of a lot of stocks are S. So the surplus, which is in the upstream, and then the downstream guys, I think there's opportunity there because the sector is looking to do. And I think that cryptocurrency, yes, this needs significant level of knowledge to approach the market, but I think there's opportunity for them, especially amidst the Trump administration.
Thank you so much to our panel. We've already got questions in right now. So one of the questions I have here says, can the rate on Treasury bill be sustainable? Ayomiko, would you like to answer that for us, please?
Interesting question, right? Like I said, we are in an era of high interest rates, and like I also highlighted earlier, last year we saw those rates were at attractive levels, right? Stop rate peaked at 23.5%, and that essentially gives you an effective yield of around 30% thereabout. So to answer the question directly, I think that those rates would likely be maintained, although it comes at a significant cost, to the federal government. Really, recently the total debt stock of Nigeria was published as at the third quarter of last year, and we saw that total debt stock climbed to around 142 trillion. Right, so it's just to show that it comes at a significant cost. But as we speak, we are at a point of, say, a trade-off, right? So you either bring interest rate down significantly and then see substantial pressure, see sell-off, from FPIs, in the money market space, right? So I think on the back of this, particularly looking at the need to keep all of those inflows from the FPIs, to keep them coming, I think the CBN will have to sustain, T-bills rates at, these current levels. From the last auction, we saw that, in fact, for the two auctions so far this year, rates have, dropped back to back. The question is, what are we going to see going forward? I think that these rates will be largely driven by liquidity conditions. If you look at the last auction that we saw, subscription on the one-day bill alone was over 2 trillion. So in events like that, in cases like that, you will likely see that the CBN will be tempted to bring down rates. But essentially, right, I think that these rates will still have to stay elevated at the 21-22% levels, and we should see that at some point we'll see further increases, right? I'm still thinking whether we could see beyond that peak that we saw in 2024, but it remains to be seen. But to answer the question, I think rates would stay elevated at these levels, but perhaps maybe towards the end of the year we might start seeing the central bank bring down rates gradually. Thank you.
Okay, thank you.
Looking at sectors, so looking at the energy space and looking at the banking space. So I think the best approach to take will be to look at indexes, but in terms of stocks, I would say within the energy space there are opportunities also in the telecom space, especially with expectations of tariff increases, stabilization in FX rates. So players within that space as well. So we're talking about MTN, for example. So I would say that these are the areas that we should generally look at if we're approaching the Nigerian stock market this year.
Okay, so next question is, what is the projection of performance in the money market instruments? Augustine, would you like to?
What is the
What is
projection?
the projection of performance in the money market instrument?
Okay, Emekun already said that we expect interest rates to remain elevated, at least the first quarter, maybe first half of the year. So year on year may be lower than what we saw last year, but should remain elevated. That's my thinking.
Okay, thank you. I believe this is the last question for today. So, Hannah, you said, given the outlook of oil by analysts for there to be a global supply glut in 2025 due to weak demand, what are the impacts on the Nigerian economy? Given that oil sale is Nigeria's main source of revenue, and this would have a ripple effect on various aspects on the economy, and what positions would you advise investors to take? Did you get that? Would you like me to go again?
Yeah.
Okay, it says, given the outlook of oil by analysts for there to be a global supply glut in 2025 due to weak demand, what are the impacts on Nigerian economy, given that oil sale is Nigeria's main source of revenue, and this would have a ripple effect on various aspects on the economy, and what positions would you advise investors to take?
Okay, so for the non-oil sector has actually been sustaining the economy. So despite the fact that yes, we expect oil glut and we expect oil prices to be around 72 to 77 range this year, if the government does not increase oil production, of course this would negatively impact GDP. But the non-oil sector has actually been doing well. Look at the financials, look at the telecoms, those services, manufacturing, those non-oil sector has actually been almost like the backbone of the economy. But when it comes to dollar revenue, to take advantage, fine, the prices will be lower, but as we produce more, you should also expect to sell more, and we know that's out there. So the more we export, the more we should see, inflows coming in. So I would say, if oil prices are going to be down, are expected or projected to be down this year, then the government should try as much as possible to also eat up. When you're looking at manufacturing, when you're looking at banking, financials, those sectors are really doing well. I really can't remember in terms of last GDP performance what they did, but those sectors have actually been doing well. So what position, I really don't think I get that what position part economy should take.
Oluchi, 5 months, particularly because we got oil production back up, I think towards 1.5. Recall that towards the end of the previous administration, oil production has dropped below 1 million barrels per day. So that sector doing well. Financial services or services particularly do well. But where we have a problem in Nigeria right now is agricultural sector, because mainly of insecurity. You can see some of the segment of that sector, like oil palm, where the likes of Okumu and Presco, because they have sort of been shielded from those insecurity issues because of the kind of plantations they manage and that is further south in the country, away from the northern side where there and middle belt areas where there's the real security issues. You can see how well those companies have done well. So if Nigeria can tighten security, get people back to the farms, the economy could do much better than what we're seeing presently.
Okay, thank you. And we've got more questions coming in, but because of time, so let's just quickly take this one. It says, what is the place of mortgage building or earnings on housing in 2025? Is it advisable to invest in the housing sectors? Mustafa, would you like to help with that?
Well, yes. So it depends on the crime, as I mentioned. So I think, there's a reflation that is happening or that is in the offing in the US. So if that's the crime you're looking at, I think that although we'll still see, interest rates, come down, and that could impact, mortgage rates, I think that would also drive, a lot of people to wanting to go into the real estate sector. So I think that the US is a good space for that. I think in Nigeria, not only real estate, but real assets in general, I think is still attractive. And I think now that we're in a time of uncertainty, a lot of investors and economists are going to be looking at those real assets to protect them from, the uncertainty, because it protects, from inflation, which has a possibility of, coming back. So I think that space is going to be one of those legacy spaces, just like some commodities that, you should look at. So I would say that it depends on the crime. The reason I mentioned that is because there are some crimes where, I wouldn't advise. So for example, in China, I wouldn't, look at the real estate space there for now. Rwanda, for example, and some other SSA countries. However, Nigeria, in the US, yes, I would say it's a space to look at.
Okay, thank you so much. Unfortunately, this is where we have to close the session. Thank you once again for joining us. I believe that this session will make today, will shape tomorrow's outcome. Now, whether you're an analyst or a policymaker, or you're, staying informed and forward thinking will be essential in navigating the financial landscape. Now, let it not end here. Let us take these lessons and perspective with us, not just as predictions, but as tools to drive smarter decisions and create lasting impact. Once again, thank you. And to our panel, thank you for taking all the time to be here. It really means a great deal. Thank you so much. And this is where we end it.
Thank you.
Thank you.
Thank you.